Good day, everyone, and thank you for joining us on Alicon Castalloy Limited's Q3 FY24 earnings call. We have with us on the call today Mr. Vimal Gupta, Group CFO, Mr. Shyam Agarwal, Chief Marketing Officer, Mr. Andreas Heim, Managing Director of Alicon Castalloy, and Mr. Rajiv Gupta, Head of Domestic Business of Alicon Castalloy Limited. Mr. Vimal Gupta will cover the financial performance for the quarter, following which Mr. Agarwal will walk us through the operating highlights. Mr. Andreas Heim and Mr. Rajiv Gupta will then provide insights on global and domestic markets respectively. Thereafter, we shall open the call for the Q&A session. Before we begin, I would like to point out that some of the statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings documents that have been shared with all of you earlier. I would now like to turn the call over to Mr. Vimal Gupta for his opening remarks. Thank you, and over to you, sir.
Good morning to all our investors. Thank you for taking the time out to join our earnings call. I trust that all of you have had a chance to review our earnings documents, which were shared over the weekend. We are delighted to report our highest ever revenue this quarter. As we have shared earlier, in recent years, there has been a strategic emphasis on serving new technology platforms in the auto industry, expansion into new geographies, the addition of capabilities, and renewed focus on value engineering. This has enabled us to surpass the milestone of 400 crores in revenue during a quarter for the first time ever, and we believe this is a positive sign of things to come. Our business transformation strategy is guided by 5 pillars, reflecting our commitment to diversify and solidify our growth levers to enable sustainable progress. Scaling strategic products in the IC business, addressing opportunities in carbon neutral technology, including battery electric vehicles, hybrid electric vehicles, fuel cell and hydrogen cell technologies, exploring opportunities from structural parts or technology agnostic components, expanding into non-auto business, leveraging our competencies in sectors such as defense, energy and telecom, enhancing customer wallet share through value-added products and comprehensive solutions. Investors should closely track the following key themes that underscore Alicon's business transformation for insights into our progress and evolving business model. So first is we continue to increase the share of passenger vehicle, the commercial vehicles, CV, in our product mix. This has reached 51% in 9 months for the financial year 24 compared to 48% in 9 months of financial year 23. Secondly, our customers profile is evolving with the addition of prestigious global names, including leading global OEMs and Tier 1 companies, highlighting Alicon's growing stature in the industry. Thirdly, our business composition is shifting towards expertise in design, research and development and value engineering. Alicon now distinguishes itself by winning businesses based on innovation, technology and design, positioning us as a solution provider rather than just a source of low-cost components. As we continue to adapt and innovate, these themes serve as key indicators for investors to assess our ongoing transformation and strategic directions. Now, turning to the financial performance for the quarter under review. In quarter 3 for financial year 24, total income reached to rupees 406 crores, that is a 12% increase compared to rupees 362 crore in quarter 3 of FY23. When we compared with the total income of rupees 382 crore in quarter 2, this indicates sequential quarter growth of 6%. Revenue growth has been driven by scaling up the production for the new parts and new logos added recently, including many critical parts being supplied to my few customers. As a result, we have witnessed an increase in utilization level, especially at the European facility. Total capacity utilization, which was 68 to 70% quarter 2, has moved to 70 to 71% Q3. The gross margin for the quarter was 51.2% in Q3 24 compared to 49.2% in Q3 of financial year 23, higher by 198 basis points on a year-on-year basis. This is primarily due to a more favorable product mix and accompanied by positive impact of the stabilizing the alloy prices at lower levels. There has been a sharp rise in employee cost, which is higher by 15% on year. Apart from the differences due to increments, there is the impact of ESOP cost of around 3.7 crore for the quarter and 10.7 crore for the 9-month period, which is a non-cash charge. Shifting to our focus to profitability, EBITDA for the quarter 3 is rupees 53 crores, a notable increase from rupees 42 crore in the same quarter of the last year, so increase of 26.2% on year-on-year basis. Despite a significant rise in employee cost, the EBITDA margin for the quarter 3 for the financial year 24 has improved to 13.1% in comparison to 11.7% in quarter 3 of financial year 23. I am pleased to share that we have reported an improvement in the EBITDA margin by 136 basis points on a year-on-year basis and by nearly 74 basis points on quarter-on-quarter basis. Importantly, if we adjust the non-cash charge for the ESOP cost, the adjusted EBITDA margin is 13.3% this quarter. This is increase of over 180 basis points on a year-on-year basis. Some of you would recall our prior earnings call where we had indicated that we will increase the EBITDA margin by 100 basis points in FY24. We have already achieved that in the first 9 months itself and will hand over to build on this further. We continue to remain confident about the general upward direction in margin given the improving product mix. Finance cost was higher by 24% on a year-on-year basis from rupees 8 crore to 10 crore in line with the higher interest rates. We also witnessed an increase in the depreciation, which was higher by 24% on a year-on-year basis from rupees 16 crore in quarter 3 last year to 20 crore in the quarter 3 of the financial year 24. The increase in depreciation has been driven by two factors. One we have taken some machines on lease, and as per the accounting standards we have to factor a maximum useful life of 5 years, which is resulted in a higher depreciation cost. Secondly, we re-evaluated and shortened the useful life of some other assets, which has also contributed to the increase in depreciation. As a result of higher finance cost and depreciation, profit after tax for the quarter 3/24 was at rupees 17 crore as compared to 16 crore in quarter 3 of financial year 23, higher by 5% year-on-year basis. On a sequential quarter, profit after tax was higher by 15% from 15 crore to 17 crore. For the 9 months ending December 23, revenue was 1,142 crore against 1,084 crore in the corresponding period last year, growing by 5%. The gross margin during the 9 months of financial year 2024 stood at 50.6% against compared to 48.5% in the 9 months of financial year 23. EBITDA for the 9 months for financial year 24 stood at rupees 140 crore against 124 crore in 9 months of financial year 23, higher by 13% year-on-year basis. Profit after tax 9 months for financial 24 stood at 41 crore against 42 crore in 9 months of the last year. In terms of capex, we have spent around 84 crore during the 9-month period, which is in line with our target capex deployment of around 90 crore in financial year 24. Coming to the outlook, as we have indicated in the prior quarter, the second half of the year will see an improvement in the revenue, given the healthy pipeline of SOP from new products and new customers. While we had delivered year-on-year revenue growth of 2% in the first half, after the strong third quarter, the year-on-year revenue growth for the 9-month period has increased to 5%. Given the muted base of the fourth quarter last year, the strong momentum in current performance, we continue to believe that we will end financial year 24 with a revenue growth of 13 to 14% for the full year. Thereafter, we are poised to take the business to a newer height as we aim to deliver a revenue of over rupees 2,200 crore by 25-26. So this equates to a CAGR of over 16% over a period of 3 years. Our confidence stems from the new orders which we have received and the discussions with the customers of new technologies and solutions. If we look into our track record with the customers, including some multi-global names, you will notice that these customers initiated the relationship with Alicon with one or two parts. They monitor our approach and carefully observe the QCDD parameters on the quality, cost, timeliness, and completeness of the delivery and gauge our overall development capabilities. Once they are confident about the comprehensive approach towards these initial parts, they proceed to expand the scope of the business relationship to offer more critical parts with a higher value addition. We are now past the stage of development of initial products with Daimler, JLR, Toyota, Stellantis, and Maruti Suzuki. The initial products are already into or will shortly commence SOP. Having earned their trust and confidence, we are now in active discussion on addition parts, jointly working on solutions and seeking value addition. This will help us scale up relationship and each of these global customers and position us to win a larger share of the business from each of them. As we scale up volumes and consequently revenues, we expect this will be accompanied by an improved margin profile. We have talked about aspiring to take the EBITDA margin to around 14%. In Q3 of FY24, the reported EBITDA margin of 31.1%, addressing the one-time expense of ESOP cost, which is a non-cash charge, brings the adjusted margin to 14%. We are looking to drive efficiencies across the balance sheet and working capital, which will contribute towards enhanced return ratios too. On that note, I would like to hand over to Mr. Shyam Agarwal, who will talk about operating highlights of the business.
Thank you, Vimalji. Greetings to all of you. We have steadily enhanced the performance in each quarter of this financial year, and the initiatives to strengthen and grow the business have helped us to post our best ever quarterly revenues. In addition to strong double-digit growth in revenue, we have witnessed improvement in margin. Further, the outlook remains promising with steady accession to the order backlog. Overall, it has been a solid quarter with progress demonstrated across all key parameters. Coming to some of the key business programs this quarter, for Toyota, where we supply cylinder head to their hybrid models, we have witnessed ramp up in volume during the quarter, and our production is running in full swing to meet the increased demand. Toyota is coming up with their third plant in India. They have already signed a MOU with Government of Karnataka for setting up the plant near Bidadi at Bengaluru. This will provide them incremental production capacity of about 1 lakh vehicles per annum. As we are an approved supplier, we will aim to capitalize on the opportunity to increase volume with this enhanced capacity. In Q3, we commenced supply of cylinder head to Stellantis India, which is for domestic market and will also be assembled and exported to Europe. Stellantis is seeking to create an engine manufacturing hub in Hosur in India, and Alicon is the single source supplier of cylinder heads for those engines. During the quarter, volumes have picked up and it will further increase in Q4 and onwards. With this business, Alicon has developed a model plant imbibing cutting-edge technology and automation for this product, which will aid in the development of the product. This will also serve as demonstration plant to other global customers of the capabilities and the global standards they can expect when partnering with Alicon. As anticipated, supplies of cylinder head to Maruti Suzuki scaled further during the quarter. The sales and production will increase further in Q4 with start of supply to Gujarat plant to Suzuki. In addition to this, one more cylinder head supply will commence from Q4. The volume of both cylinder heads combined will provide significant volume increase in financial year 2025 from Maruti Suzuki. We expect better level of activities in Q4 and into the next financial year, given the visibility provided by the commencement of supply for these parts, expected increase in volume for active parts and SOP for few parts under development, all of which will contribute to enhanced revenue momentum. The other aspect of highlight is improving product mix. Alongside the increasing share of products for ICE being supplied to passenger vehicles and commercial vehicles is the increasing share of business catering to the EV and carbon neutral segments. The share of business from EV is into double digits at 11% for 9 months of financial year 24, as has nearly doubled from 6% share in the 9 months period last year. We expect product mix to be further enriched as all of the new business that we have won this quarter is for supplying parts for four-wheeler and to global customers, which is aligned to our strategy of focusing on higher value parts. Moving beyond the lever of product mix and customer set, we have also implemented initiatives and aimed at providing operational excellence and elevating our competitiveness. We have enhanced the machining capability and the capacity at Shikrapur facility with installation of advanced equipment. Enriching the competencies will aid in enhancing customer wallet share and while raising the proportion of value addition. Further, we have added a machine of larger size which can manufacture parts up to 2 meters in length, enhancing the capability of the European operation. We have also augmented our team by adding personnel with rich experience in project engineering, tool making and single component to add their know-how to our operation. To this end, we are also actively recruiting experts in casting and machining, strengthening our global team. To further sharpen manufacturing prowess and process expertise, we are proactively deploying digital process control. This involves incorporating machine intelligence to add an extra layer of supervision to our production process, ensuring elevated precision and efficiency. The implementation of these controls will not only empower us with real-time data, but will also play a pivotal role in actively managing operations and furnishing valuable insights for informed decision-making moving forward. In the area of cost competitiveness, our efforts towards diversifying the energy mix are bearing fruit. As we have shared earlier, solar panels have been installed on the rooftop of our plant in India and in Europe. Further, we have acquired share in solar installation and initiated a solar power agreement of 5.2 megawatt, which will enable us to achieve equivalent credit for the units which are fed into national grid. This will operational in August 2024 and units fed into the grid will adjust against the unit we consume at our manufacturing plant. With this initiative, the percentage of solar in our energy mix will cross 50%. These factors are serving to enhance the differentiation of Alicon in the global marketplace. In addition, is our USP of being able to serve our customer both in India as well as from our plant in Europe. The simultaneous presence in domestic and international locations has served as a key differentiator and proved advantageous in negotiations with global customers. On this note, I would like now to hand over to Mr. Andreas Heim, who will cover the development in the international business for the quarter.
Andreas, over to you.
Andreas, now you can take over.
Yes, thank you. Thank you, Shyam. Good afternoon, everyone. The international business has delivered a strong performance we scale up by customers and improved visibility of performance due to the increased pace of additions. One of the key developments was the approval of the prototype of the E-axle for JLR, with schedule for commencement of supplies along being concluded. During Q3, we commenced the initial proto supplies of this E-axle housing. Further, we've seen an increase in the volume by 3 times in the auto business. A couple of important perspectives to share about the JLR order. Given the criticality of the order and the stature of the customers as a leading manufacturing, we extend ourselves in order to win the business. We involve partners from Europe for mold making, part development and machining to ensure that we de-risk the project. We were very keen to ensure that specifications were met, that we got it right the first time, and to shorten the lead time for the customer. The degree of involvement extended by us was highly appreciated by JLR, and their teams significantly improved the engagement and coordination at the development stage, which was a key factor in achieving the degree of success that we are sharing with you all of today. JLR has recognized that Alicon is not merely offering a product, but it's equally invested in offering solutions. Secondly, we have highly diversity product range, which allows the customers to view us as a single source supplier. Customers realize that they can produce their requirements for ICE, hybrid and EV vehicles from a single supplier, and hence they to seek out one-stop solutions. During the quarter, we also won an order from Obereigner. This is for an electric drive unit or EDU, which Obereigner requires for developing all-wheel drives for light commercial vehicles. This will result in a world supply to the prominent LCV manufacturers in Europe, such as Daimler and Volkswagen. Other prominent customers, such as Dana, Danfoss, Taco and Mahle, which we have started with small projects and now in discussions to add more sustainable business. We anticipate better growth from these global names in the coming years. In addition to direct supplies to OEMs, we were equally engaged with Tier 1 suppliers where we provide solutions. As we continue to observe strong growth potentials for several Tier 1 suppliers in their chosen niches, we believe there will be a cascading effect to Alicon for supply of products. With these developments, the global business contributed to 28% of the total revenue during the quarter and 23% during the 9 months, compared to 20% in Q2 and 21% in the 6 months period, indicating a creation in international business in a single quarter. The share of international business can improve further, as during the quarter we added 30 new parts from 4 customers. This includes 2 parts from EV or carbon neutral and 11 parts from ICE. All 13 parts penetrate to international business. In carbon neutral business, we added another part from Scania for the European market, and we have also added 1 part from Danfoss. In the ICE segment, we further added 8 new parts from Daimler Europe and 3 parts from Obereigner. In terms of operating landscape, we see normalcy returning in Europe. Electricity and gas prices are stable and availability has also improved. In terms of raw materials, aluminum prices have been less volatile than in the past. For diversifying our energy mix, we install solar panels on the rooftop of the manufacturing facility, and these have been running live since January, enable us to reduce energy costs and enhance our sustainable footprint. With that, I will hand over the call now to Mr. Rajiv Gupta, who will take you through developments in the domestic business.
Thank you, Andreas. Good day, everyone. In Q3 FY24 auto dispatches, the industry showed an improved performance, especially the two-wheeler segment, which witnessed healthy double-digit YOY growth. This includes 5% growth in passenger vehicle segment on a year-on-year basis, 6% growth in the commercial vehicle segment on a YOY basis, and 19% growth in two-wheeler segment on YOY basis. Within the passenger segment, there is clearly dominance of UVs with both customer interest and market share steadily rising. Other categories within PV segment still face mixed demand. The domestic commercial vehicles industry volumes continued to do well, and there was an increase of 6% YOY in the segment, despite seasonality on account of good momentum in the infrastructure and construction segment, as well as steady growth in economic activity as indicated by GST collections. The domestic two-wheeler industry was expected to benefit from higher volumes on account of festive season, while there has been improved momentum and base quarter last year was impacted due to drop in demand on account of OBD regulations. Further, we believe the electric two-wheeler players are yet to regain lost ground. However, here are signs of stabilization there, and impending launch of new models is likely to kickstart the demand cycle. Compared to this, at Alicon, we saw the following trends. 31% growth in sales to passenger vehicle segment on YOY basis, 9% growth in sales to commercial segment on YOY basis, and 8% growth in sales to two-wheeler segment on YOY basis. In terms of new business, we commenced the supply of one cylinder head to Maruti Suzuki. We are also working on development of one more cylinder head, which is for an SUV platform. As the demand of SUVs in robust and market share continues to rise, we expect this product to provide significant volumes once it enters production phase. From Daimler, we added new business comprising a large package with commitment for long-term supplies. The product that we have added envisages supplies commencing from 2026 with expected delivery up to 2035. With the increasing engagement, we are in discussion for further businesses and to offer further solutions in upcoming models. Even the two-wheeler customers such as Honda, Hero, Royal Enfield are projecting strong set of numbers for the coming quarters, which will help Alicon to gain more volume of business. We also see some revival in momentum in the non-auto with the increasing spend of the government infrastructure and defense and the renewed vigor for Make in India campaign. As you may be aware, for the last several years, we have been supplying aluminium wheels to enable lightweighting of battle tanks. With a healthy level of demand witnessing for our products catering to the defense sector, we are now in discussion on a new tender in this quarter for supplies of product comprising road wheels as well as cylinder head, which is to be commenced on an immediate basis. Further, we are in discussion to add products for the larger size battle tanks. During quarter 3 FY24, Alicon have booked a new orders aggregating rupees 682 crores. With this, a total new order booking has reached to rupees 9,000 crore, which is executable over a period of 6 years from 2023-24 up to 2028-29. Please note that this is net new business and the products for which SOP has already commenced and expected to continue and are not a part of this number. Some steps being taken to enhance our competitiveness include the initial phases of our automation journey. A roadmap has been devised to access areas ripe for automation within our processes. We are diligently evaluating the advantages and efficiencies that this paradigm shift can bring, segmenting components of our processes into different stages as one ready for fully automation, second ready for partial automation, and third not suitable for automation. We believe the benefits are manifold and expect automation to not only yield cost efficiencies but also evaluate process excellence and product quality throughout our operational landscape. On this note, we are now we can open the floor for questions.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and one on the touchtone phone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take the first question from the line of Yash Dalal from Sushil Financial Services. Please go ahead.
Hello. Yes. Hi. Firstly, congratulations to the management for achieving record revenues this quarter, and thank you for this opportunity. So I had a few questions. First was, what is the volume growth in Q3, and what is the fall in realization this quarter due to raw material price fall? Could you please guide us on the same?
Sir, on the management's line, I would request you to kindly unmute yourself and speak, please.
Hello. Yes, on the increase in on the sales for quarter 3, we have noted an increase of 12% over the last year quarter 3.
Okay.
And 5% on quarter-on-quarter basis. And just what is your second question?
Yeah, so what is the fall in realization this quarter due to raw material price fall?
Yes, for the quarter actually, when we worked out this due to the impact of aluminium prices. So for the full year, we are estimating approximately 50 crores is the impact. That converts into 3% of the sales. So that is the impact. So when we are talking about to reach our full year growth of approximately 30 to 14%, so you can add up. So easily we can say 16 to 17% in real numbers.
Okay. And so we were focusing on the reduction of noise parts. What has been the contribution this quarter?
Yeah, yes, I will take this question. So for the noise part, as you know, it's part of our strategy and the customer also, because when they place the order in a bunch that we have to take the small volume part as well as the high volume part also. So we cannot deny our customer to give us the low volume part. However, in isolation, if some low volume parts are coming, so we generally deny those parts. And the earlier prevailing parts, which were in the production, is now, going out with the life of those products are pending. So we are reducing significantly the noise parts.
Okay. And so another question is, you had mentioned previously ROCE to be at 25% when we reach our guided revenue of 2,200 crores. Are we on track for that?
Oh, ROCE 25%, so we have not given the guidance. For 25% ROCE guidance, that is our aim, that is the goal. But by 25-26, that is a difficult target what you are talking about. So because year on year there will be a growth, and we have a good target for maybe we can say on at least 2% year on year basis every year, some improvement we can see in the ROCE.
Okay. And any capacity additions needed for FY25 and FY26?
Yes, that when we are talking about the continuous growth, and we have given the guidance for 25-26 for 22 crores plus, and we are moving from small parts to bigger and critical parts. So we need some new equipment, all this. So in this year, as we have guided approximately more than 80 crores, we have already invested in the 9 months, and for full year maybe 100 plus we will be there. And next year, now we are adding more capacities to be ready for the 25-26. So maybe 120 to 130 crores at this moment. The expectation is for the investment in the next year.
Okay, all right. And just a final question. So the ESOP impact, what will be the impact continuing in the next financial year?
The next year, very small impact, because this year approximately around 15 crore impact will be there, but next year maybe 3 to 4 crores, not more than that.
Okay. Thank you so much. That's it from my end.
Thank you. We'll take the next question from the line of Jyoti Singh from Arihant Capital Markets Limited. Please go ahead.
Yeah, thank you for the opportunity. And sir, congratulations on the good execution and better set of order books. So my question is on the export side first. Is there any seasonality pattern in H2?
Our global numbers, yes, we noted have increased in Q3 also, and that was led with an opportunity of delivering a critical part to Jaguar. So, talking about global market numbers, we are in discussion with existing customers where the anticipated volumes will be muted, not that aggressive, but Alicon is able to grow more against those numbers as we are penetrating with more of such parts with existing and also tapping new customers. So yes, going forward, we see volume might be on lower side, but of the auto industry in global terms. But we see we are going to overpass those numbers with the additions what we have done in past and also being aggressive going forward.
Okay. So, Jyoti, for this quarter, we have reached the global sales of 28%. When we made a comparison for the last year, it was I think 20-21%. So there is a big jump in the numbers, and continuously as we are explaining that our focus is on the global business. So we are expecting to grow year on year in this global business.
Okay. Sir, we have done very good on the year-on-year basis, but if we see on a month-on-month basis, so that's not that great. So, any reason for that, sir?
Where we are not achieved on quarter-on-quarter basis, which numbers?
No, I'm asking a month-on-month basis. So like, if I compare December to January, so like it's not that great.
So maybe.
Okay, we can discuss later on this, sir. So like my another.
Where you are coming from, those numbers are not clear. Because we have not declared any month-on-month number.
Yeah, fine, sir. We can discuss on that later. So, like, my next question is on the Maruti side. Like, we are getting order, going to get the order from Maruti Gujarat plant. So, are there any product besides cylinder head, or only will be doing the cylinder head part?
Cylinder is the A-class part where we try to gather or participate with our customers. There are other opportunities also when you talk about low pressure and GDC, what we are into. But our main focus is cylinder because it's a A-class part and gives you good recognition and value addition to a customer.
Mainly that we need to understand, like from Maruti Suzuki, you know the volumes, what kind of volumes they are having. And first of all, there is entry into cylinder head. And at present, we are having very low volumes, approximately 40 to 50,000 a year on that basis. But now they are increasing that wallet and giving the opportunity to enter into their new models. So like when we are talking about it was a 1.2 liters, so 1 liter, 1.5 liters. So all these new models are coming up. And in the coming period, maybe for we are expecting to deliver good numbers for 24-25. So that is the first big opportunity we are having, and maybe we'll see that based on the performance. So the opportunities are there for the other new parts.
Yeah, Jyoti, I would like to add. You already know that the relationship between Maruti Suzuki and Toyota, and we are already supplying the hybrid cylinder head to Toyota, which is a very, very complex part. And first time in the history of Toyota, they have outsourced the cylinder head. And Toyota will assemble the engines for the hybrid in their plant to supply to Maruti Suzuki. So that way, Maruti Suzuki is also very confident about the capacity and the capability of Alicon, and that is also helping us to increase the turnover and the business relationship with the Maruti. And as Vimal sir explained, the Maruti owns almost 45% share of business for the Indian market. So those will be a huge number for Alicon. Thank you.
Yeah, thank you, sir, on that. And so another, like we are doing in two-wheeler, almost 50% market share in the two-wheeler cylinder head. So similarly, we are targeting in the four-wheeler?
Yes, that's what we were trying to explain. So ideally, this four-wheeler cylinder heads, if you go back the traditional way, it was being manufactured at customer end because it was a A-class critical part which customers were not willing to offer or share the know-how to others. But we got this, traditionally the cylinder for four-wheelers, they were doing in-house or they were offloading to a technical partner who are expertise in this domain. But we got this entry into the cylinder way back in 2018 when Renault came to India and were very aggressive on price and were looking for suppliers who can match that price and deliver such a critical part. So we got renowned with Renault for India. Eventually after a year, we got this opportunity to supply to the Brazil location. This gave a lot of visibility to existing and upcoming customers. Secondly, then we got this opportunity with Toyota when they recognized our successful deliveries, and as Mr. Sham explained, first time in the history of Toyota they outsourced and they were comfortable with Alicon, and this is a history of 70 years. And thereafter we got again a breakthrough with Stellantis. So Stellantis came up in India again 2 years ago, and they are aiming to make engines of 300,000 a year. It's a big volume for India as well as for global market. So there also we got an entry supplying cylinder heads for 100% volumes. And even for that cylinder, we made a model cell with a lot of automations, like auto pouring, the core extraction, casting extraction. So we made our model cell to explain our customers and prospective customers. So basically these steps are again the customers understood that even Alicon is a company who can deliver such critical parts and can participate in the upcoming developments. And also, like Maruti now started offloading the cylinders. So we now, going forward, we are aiming to increase penetration with our existing domestic customers and also to explore the global customers, which in coming quarters you might see, because strong discussions are already started with few global customers, which we see an opportunity to convert in coming quarters.
So Jyoti, if we conclude that your question, so the two-wheeler we are already down from 50% to 42%. So that share is going down and the four-wheeler is started increasing. And hopefully next 3 to 4 years, we will have a much bigger share of four-wheeler if you compare with the two-wheeler. So two-wheeler will be on the lower side in comparison to the four-wheeler.
Okay, thank you, sir. And sir, my next question is on the JLR order. So could you offer insight into the JLR order specific and the expected quarterly delivery volumes, if we can disclose on please?
Yes, so this order we backed almost a year and a half ago, and this is a big order. These are two parts ideally of 28 kg. So ideally two parts to one vehicle with a volume of 250,000 a year. And this is one of the critical and complex part for the EV vehicle. And this is for the existing, the ICE Range Rovers and Land Rovers which you see in the roads. So ideally they are going to replace those models with the EV. So this will go to that platform. It's a huge opportunity where they are anticipating to cover global volumes. Talking about our supplies, we started this development, initial supplies from Europe as a soft tooling, and which we have noted that we have already started supplies in this quarter. Eventually we see volumes in coming 1 or 2 quarters, and we are now already in full-fledged execution plan to deliver this part from our Indian locations. So we are planning to submit the initial samples in next couple of quarters, and thereafter to start supplies in the coming years.
Mainly this year, we have already started supplies in the year of 23-24. So we have in the impact in quarter 3 of the current year, as well as it will continue because quarter 4 and then quarter 1 of the next year, quarter 2. But these are the proto businesses and because it is in development stage. And the mass volume will start from the 25-26. So in the 25-26, hopefully they will have the volume of
175.
Around 150 to 170,000 numbers. So that is the expectation. So maybe 150 to 200 crore addition in the sales we can see from there.
Okay, thank you, sir. So my last question on the growth side. So what are expectations for the 25 and 26?
So sales 25-26, our target is 2,200 crores, and hopefully we should be able to achieve that, and we are in the right direction.
Okay, thanks a lot.
Thank you. We'll take the next question from the line of Faisal Zubair Hawa from HG Hawa and Company. Please go ahead.
So what is the chances that, we move our capacity utilization up to at least above 80% levels, because only that will improve, our ROC and ROE quite well. And what does it need as far as, shop floor changes, or is it that the orders that we have received are having some, time gaps, due to which we are not able to reach this capacity utilization?
So I just explained it. So first one, we are talking about that how to improve our capacity utilization. So mainly we have to understand the processes here, because there is a fluctuating volumes, and we have to keep our capacities idle for the customers' volume fluctuations, because it is not a constant, and there is a consistency in the volumes. So that takes around 15 to 20% that capacity we have to keep idle. And secondly is that when every time we are talking about what are the structural changes coming in the Alicon business. So all machines, we are using, those are not 100% convertible from one part to another part. So somewhere we have to use a dedicated machines for the particular parts. So when degree shifting is happening from smaller parts from two-wheeler to when we are moving to the critical parts, so 100% utilization and conversion will not happen. So some capacities or some machines we will have to keep idle for this and add new machines. So, and when we are talking about the utilization, when we are going for the new businesses also, so like when we are adding the machines here in this year for maybe a 23, 24, so those we have to put the capacities, but the utilization and maybe 70 or 80% will happen maybe after 6 months and 9 months. After putting up the capacities, and during that period we have to put another capacity. So there is a continuous process. So that makes our capacity idle for maybe 25 to 30%.
So then what is the second method of improving the ROC, ROE? Because, whatever you may say about product mix and all, if the ROC and ROE doesn't come in, that means it is not a very capital efficient business.
No, industry is a capital, we need capital, but you see that on last 4-5 years, the continuous improvement in the ROC, ROE you will find. And ROC, this year also we are going to improve more than 2%, and that I'm explaining. So maybe next 2 to 3 years we should be able to cross 20%. So that is the first target we are having.
Okay. Thank you, sir.
Thank you. The next question is from the line of Manas Jain from Just Enterprises. Please go ahead.
Yeah, hello, Manas here. Just one bookkeeping question. So the incremental sales, what we have delivered from quarter on quarter, I believe this is more pertaining to Maruti and Toyota. So is this being recorded from the European entity, or because I saw that incremental change was in the consolidated numbers? So I just wanted to clarify that.
This Maruti, what we are saying that now this is a structural change is happening in Alicon Group sales. So like when we are explaining the growth in the sales of Maruti and Toyota, so on the other side we are also saying that the two-wheeler sales is not up to that level of that industry is performing. So the growth this quarter is main growth has come from the Europe, because earlier this JLR development, prototype business, everything was planned in India. But now seeing the criticality, so it was decided by the management and the board to do all these developments in Europe, because due to the availability of the machines, availability of the technology, the technical people, the tooling. So it is not like that in Europe it is happening, but Indian sales is happening in Europe. That was supposed to earlier in India.
Okay. And second question is that, I mean, what is the anticipated growth rate we are seeing for next year? I understand you said 16% CAGR, but just next year, what is your guidance?
So it is a very rough idea, because we are also in discussion with the customers, but our expectation is between 16 to 18% growth at least.
Okay. Thank you.
Thank you. We'll take the next question from the line of Prolin, an individual investor. Please go ahead.
Yeah, hi team. Thank you for taking my question. I have one suggestion, right? I mean, can you be kind enough to include your order book quarter on quarter in your presentation, so that we can see a clear trend of what is happening in the last 8 to 10 quarters. So that is on the suggestion side. But coming to the larger question of your order book, right? I mean, you mentioned a number, right? I mean, can you give me some construct in terms of what does this order book constitutes, right? I mean, in terms of two-wheeler, four-wheeler, EV, non-EV, defense, non-auto. Can you give some texture on what is the order book looking like?
Yes. So this order, what we have booked till now, if we see from the outlook of sales from 23, 24 to 28, 29.
So actually, if I just give a little background, so just to start with Rajiv, when we give the complete structure of the sales. So first of all, the order book, what we are talking about, it is around 9,000 crores. That will start base year of 23-24. In the current year of 23-24, out of this maybe approximately 700 plus crores we are going to execute it. So he is going to give this breakup because we are not now considering the old stuff that is already happened till 22-23.
Sure.
Yeah. Now, Rajiv.
So if you talk about the contribution of this order book, around 32% goes with the EV parts. So this is again where we wanted to enter, and we are very happy and pleased to share that we have done quite well in this area where a lot of companies still in India are just starting up to enter. Second is even on the technology agnostic, where we are aiming to leave a good mark, where we have touched around 6%. So that is also...
So technology agnostic is that where it doesn't matter whether we are manufacturing, it is going for IC or EV.
Correct.
If we see further, exports are around 55 to 56%.
So that is a major thing is going to happen when we are targeting to export to contribute. Means export is global business including our European facilities. So 50% of the total revenues that we are targeting.
And if we see segment wise, this contributes around 80 to 84% the four-wheelers where we were aiming to increase our share. So just around 10 to 12% is to two-wheeler, rest is to the four-wheelers where we were aiming to increase our penetration. So there we have done well as per our strategy.
So this is another answer to the Jyoti Singh from I think Aryan. So the structural change in two-wheeler and four-wheeler. So major contribution will come from the four-wheeler and going to replace the two-wheeler major this big contribution.
And non-auto would be what part of our order book, sir?
Non-auto looks to be around 4 to 5%.
Okay. And in case if, some of these discussions that we are having on defense side, in case if they fructify, I assume that the thing that you mentioned, right, I mean on the defense, the comment that you made, that is not part of your 9,000 crores order book. So can we see that in case if some of these discussion on defense turn out to be in our favor, the share of non-auto will go up? Is that a fair way to look at it?
Prolin, just to update, those numbers, what we are in discussion with the defense team is not included in 9,000 crores. That is true. So that will be over and above of the 9,000 crores. But secondly, what is happening, our order book is so high with the automotive businesses that if you see the percentage term, although we are in the non-auto in the absolute value, but in percentage term, it always looks low. Because we are playing much bigger role in the automotive.
Sure, correct. And one more question on my side. I have been tracking your company for quite some time now, right? What I find a bit difficult to understand is that we have such large order book, right? I mean, such marquee customers. The transformation here that you talk about from two-wheeler to four-wheeler is happening at, in order book is very visible. But that is yet to see its true colors in the form of revenue. So what I understand is that, let's say, for example, this year we will end up somewhere between 1,450 to 1,550 odd crores. So there is a part of that revenue which in a way is a drag, which in a way is reducing, which in a way you consciously also want to reduce, right? Because you want to move away from that. Because if I look at your this year's revenue of let's say 1,550 crores, 700 crores is coming from incremental order book, which means that there is a part of the business which is dragging our overall numbers, right? Could you quantify what part of our business is declining, right? I mean, for whatsoever reason, conscious or market-related reasons, right, in some sense. And in which year do we see that this incremental order book will probably be more than enough to take care of this drag that we are, talking about? So can you just philosophically help me understand this question?
In this, actually, what is happening, we are already explaining that we are reducing the business size of this noise businesses. We have stopped this, and there is a life cycle of the products. So maybe 5 years, 7 years. So some parts are already going down. The volumes are going down, and maybe when they are contributing maybe 50 crores, now the contribution is gone to 5 or 10 crores. So that is a continuous process that is going to happen, and it will continue. And as well as when we are going for the new businesses, earlier maybe the life cycle of the parts was 10 years or 12 years, or maybe I have seen the 15 years. But now it is reducing to 6 to 7 years. So that is happening, and that is the reason if you add from the existing business and the new businesses, so that will not end up in the total sales. So definitely there is definitely the decline in the regular already running businesses. So, and especially when we are not taking, because this is our management strategic decision also from the management. No, because you know that if we want to go to increase our top line, it is very easy for us. Just reduce my prices or something, some relaxation due to the customer. Immediately I will be flooded with the order book. Right? But our aim is to improve the bottom line, same time. Now you are seeing that people are asking for the ROC improvement, the EBITDA margin improvement, the bottom, this PBT, PAT improvement. So all this happens when we see that I have to compromise on the low margin businesses.
So how do we quantify it, sir? I mean, let's say, for example, if this year we do close to 1550 crores of turnover, out of that you are saying that 700 crores is coming from that order book that you have always been talking about. So let's say 50% of your FY24 sales is coming from the incremental order book. Out of that remaining 50% of 750 crores, that's your core business. What is the kind of decline that we are...
Decline easily we can calculate. Suppose like when we are talking about... because in the last year, maybe if I say that 450 crore addition has come from the new businesses, and this year I'm talking about that 750 crore. So around 300 crore increase from the existing, from the new order book. But the overall increase has happened approximately it will happen approximately 200 crore. So 100 crore it has gone down. Maybe out of this 100 crore, 50 crore I have explained due to the impact of the aluminum prices.
Sure. So how
this is a complete combination, because it's very difficult to quantify due to this declining, because many permutation combinations are there to work out this. But when we talk about just a rough idea just given to you.
No, that's fair. But I mean, let's say, for example, if you can't quantify in rupees crore, is it fair to say that, let's say, in FY25 on a whole year basis, your new order book or incremental order book will be substantial, or will it be 26 in that year in FY26, where we won't be talking about this noise equipment, so to say, right, in some sense, or noise supply? Which year that would be where this drag is, I mean, very low, that we don't discuss at all, right, in some sense? When do you think that year will arrive? Will it be next year, or will it be 26?
Around 70 to 80% you will see in the next year, and yes, in 25-26 you will see around 90 to 95%.
Right. So 25-26 is when all these efforts that they are making since past 2 to 3 years will finally show results in terms of pure sales and then margins and ROC in our numbers, right? I mean, is there a fair summarization?
That is the take-off year, yeah, we can say that 25%.
Okay. Thanks a lot, team, for taking my question, and wish you all the best.
Thank you.
Thank you. The next question is from the line of Kumar Saurabh from Scientific Investing. Please go ahead.
Hello, sir. So first, congratulations for beating the market industry in last 3-4 years and having an aspiration to do that for next 2-3 years. I have 3 broad question areas. The first is on aspirational growth rate, and to achieve that growth rate, we are of course dependent on industry to do well. And if we look at the auto cycle, of course, depending on whether it's commercial or PV or two-wheeler, the cycles are different, but 2 to 4 years, the cycles top out. And we have an experience from 2018-19, and though we have beaten the market, the kind of aspiration we had that time we couldn't achieve. So from a risk perspective, we are doing well. We have good order book. But how do you see from an industry cycle perspective, are we confident that we will achieve this number? We have a good order book, but do you see, based on your learnings from past cycles, do you see if the industry cycle tops out, the order book can also reduce? So my broad question is, given the industry context and the cyclicity of industry, how confident we are to achieve this aspirational growth? My second question is around our technical capabilities. So, in a layman term, and we have invested a lot in last 2-3 years to build the technical capabilities, and it is getting reflected in terms of the four-wheeler order book, in terms of the growth and all of that. But if in layman term you can explain how we are technologically better than our competitors, and in all these new kind of businesses who are our two close competitors, and how we are better than them, what we have done in layman terms, that will be good. And the third question is more around financials. So of course, I think in last 3-4 years from a 10% ROCE, we have gone to 14% ROCE. We have aspiration to go to 19 to 20%. So how that will happen? Will that happen because a four-wheeler business will be a higher margin business compared to a two-wheeler business, or whether it will lead because of better asset utilization? I also see your cash flow conversions have also improved. Like if I look at 8 year versus 5 years versus 3-year trajectory, your EBITDA to cash flow conversion is improving. Is it because of working capital improvement? I just want to understand the drivers of how the better ROCE will be achieved. So these are my 3 broad question areas.
Thanks, Saurabh. A lot of points you have covered. Talking first on the first point, yes, even we have noticed volumes are moderate, unlike 2018-19, where the industry was noticing a double-digit growth. And a lot of changes were noted. Like traditionally, a development by any OEM, the product were live for maybe 10 years, 15, or some case Maruti we have noticed 20 to 25 years. But now we are noticing the lifespan of product is very slow. And that's the reason after 18-19, we understood the urgency to enter in different portfolios, like penetrate with existing customers and enhance our portfolio, add new parts from existing customers, and also look for new customers in domestic as well as global regions. So we have done predominantly very good in these areas. Also, we were aiming to shift our focus from passenger vehicle, from two-wheelers to passenger and commercial vehicles. And also we were aiming to, how to drive further was to increase the value addition. Like if you see traditionally, we were 50% with a two-wheeler where the option to supply machine part was very rare. But as the shift is going, the customers are looking for a ready-to-use component in their assembly, which includes the value addition. So on that ground also we see good momentum. And as the industry is also noticing a changeover from ICE to EV, the OEM, the majorly four-wheeler OEMs are looking to see partners, not suppliers, but partners who are capable of giving such critical solutions. Like the example of Maruti, they are offloading Maruti, 50% of the volume of the market share is a big volume, and they are coming up and giving opportunity to Alicon. Toyota, we have seen an example. So some developments we see is a good opportunity to overpass the traditional numbers of growth and leave a good mark in the growth numbers.
So mainly in this, we are not totally dependent on the growth of the industry. So always looking for the new parts, new customers, and expanding ourselves in that area. So that is giving the major support for the growth. As well as when we talk about, because you see that cycle is there always, but at this moment looks like that chances are less for this downfall, because the government see the policies, the infrastructure investment done by the government, and development, lot of new highways, roads are coming up. So the demand is growing in the automobile. That clearly we can see in this. Maybe somewhere a little bit it has to improve on the lower cost vehicles. but on the mid-size and the larger luxurious side, the growth is phenomenal. So that is the area, and like that, and when we are talking about the technology, like Rajiv has explained, so maybe Shyam would like to explain on that.
Yeah. On the technology front, if you see, like we are supplying almost 90 parts for the EV industry, and this journey we started in 2016 and 17 in Europe. We have an advantage that we have a plant in Europe. So whatever the European requirement, which comes in advance of 5 to 6 years of India, so that we developed and already mastered those capabilities. So when these products like motor housing now coming to India, so we were the first choice for the OEM and also the supplier tier 1, and they chosen us. So now we have developed good competencies on very critical parts where we have a thermal engineering solutions which we are providing. So those solutions are very liked by the EV customers, and especially if you see the motor housing and now the e-axle part, which is also very, very complex part, and even JLR appreciated the efforts of Alicon to develop such a critical part at first time, right? So if you see in this area, we have developed lots of competencies with the help of our European arm, and now we have mastered those technologies in India. So if you see our customer base, we have all the marquee customers in our customer base, and in the EV, we have developed most of the critical parts which comes out from the aluminum casting from the LPDC and GDC. So this gives us a good base to develop further competencies and increase our share with the customers. Now, secondly, we are also working on the HPDC parts. We have already got the order of onboard charger, which is a very complex part. It is in HPDC, the assembly of 3 parts. So we will also moving up the value chain by supplying the assembled part with the friction stir welding. So our management is very, very focused on working on the new technologies and master those technologies so that we can increase our revenues and also the bottom line. I hope, Kumar, we were able to answer your questions.
Yes, sir. Thanks a lot. And if you can, thanks for the elaborate answer. And if you can, one, discuss on the financial side and who are the close competitors in all these emerging areas of business?
Okay.
Talking about competition for Alicon, we have got competition segment base. And also it's the customer in-house OEMs. I mean the in-house OEMs like Maruti, Toyota, the in-house foundry we are competing. Talking about two-wheelers, yes, there are various players, but yes, we pioneers in terms of solutions, in terms of delivery, in terms of volumes, because we being a big player in this region and serving since long. And in four-wheelers, yes, we are competing. One is OEM and second is several domestic as well as global players. Like to name some, it's Limac, it's Craftsman, it's Linamar, where we are aiming to grab those shares and thereafter cater to our customers.
Actually, these big players are not our competitors, but we have to become their competitors. Now we have to enter in their area.
Thanks, sir. And on the financial side, like what will drive the ROCE to, higher numbers?
So definitely, that the structural change in the business when we are moving from this low margin business to the higher margin. So that is the major driver, and we are more focused on the cost downs, as well as now we are seeing that maybe we have seen that the improvements, but definitely again we are more focused on how to control our working capital, maybe in discussions with the various customers for their terms also. And another side is that the investments, how to control and maybe to reduce our investments. So definitely based on this, maybe for our capital employed control will be there. So that is hand to hand. It is linked with each other, but there is definitely a clear our roadmap we are having to improve our the margin as well as the ROC.
Sure, sir. And one last question. I don't know if you looked at the business from this angle. So when we look at auto industry and when we look at the low cost auto versus, the premium, whether you look at two-wheeler, the low cost two-wheelers have suffered, the premiums do relatively better. When it comes to four-wheeler, we know in Maruti also the low cost segment is not doing well. So when we supply as an ancillary player, we supply parts to, the various two-wheeler, four-wheeler CV companies. If we talk in terms of revenue distribution, how much is there in low cost versus high cost, and is there an intent to move our more and more revenue from low cost, OEM products to higher cost OEM products? Any views on that?
Yeah, Kumar. Like if you see in two-wheeler, we are supplying the part to low cost two-wheeler as well as to the high cost. If you see the Royal Enfield, so there also we are supplying, and in most of the models we are single source. And if you see the four-wheeler also, so we are supplying to Toyota Hi-Cross. And if you see the cost of that vehicle is more than 30, almost 40 lakhs you can consider, and you see the waiting period. So we are across the segment, and our endeavor, of course, will be to supply the high value parts to all OEMs, but to generate revenue across all segments, we cater all segments. However, the focus will remain always on the high value segment parts.
Got it. Thanks a lot, sir. Thanks for all the detailed answer and wish you all the best.
Thank you, Kumar.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Thank you. I hope we have been able to answer all your questions satisfactorily. Should you need any further clarification or would like to know more about the company, please feel free to contact our team or CDR India. Thank you once again for taking the time to join us on this call, and we look forward to interacting next quarter. Thank you very much.
Thank you, members of the management. Ladies and gentlemen, on behalf of Alicon Castalloy Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.